Hi there, my name is Ken Fear with SFG Financial Solutions. And in this video, we're going to go over fixed index annuities. We're going to go over how they work. We're going to compare them to a fixed annuity. We're going to compare them to variable annuities. And we're also going to go over why they've gained such popularity over the last decade or so. And we're going to discuss the different options and why you may want to incorporate this as part of your retirement plan. We're going to also go over some of the key benefits they provide, such as lifetime income riders, guaranteeing that you won't ever run out of money, healthcare costs, making sure that those costs are taken care of. So feel free to take some notes, write down some questions, book an appointment with me or one of my agents afterwards. We can review your current financial situation, your retirement goals and concerns, and see if a fixed index annuity is a good fit for you. Okay, so let's dive into it. So here at SFG Financial Solutions, we focus on retirement planning, debt elimination, tax strategies, and asset and income protection. We do that by really working with some of the top financial and insurance companies in the country, and we really tailor our plans based on our clients' needs and goals. So we get to pick the cream of the crop based on what they're looking for, and we get to pick the best products out there based on these different company offerings. So we have some keys to a successful retirement plan. So the first thing is safety. So 100% contractual guarantee of your money. Second key factor we focus on is growth. So, which is we lock in your gains and have 0 down years. So when you get to a certain point in your life, you don't want to have any down years. So income withdrawals or guaranteed lifetime income riders, which we'll talk about. Healthcare costs, obviously that's a big concern for a lot of people. So we talk about how we can help cover some of those costs if you need that at any point. Taxes, only pay taxes on the money you use. We also have some great strategies for doing some Roth conversions, with inside fixed index annuities, and as well as wealth transfer. So one of the most efficient ways to pass on money to our loved ones when we pass away. So there's really 3 phases to when we do retirement planning. So the first phase is saving, right? Saving for retirement, putting money aside, obviously is phase 1. The second phase is retirement asset protection, and that's where fixed index annuities really shine, right? So that's where people implement those based on their journey here. So, and then the third thing is income during retirement, where again, that's where fixed index annuities can do that through lifetime income riders or withdrawals as you need money. So this is a great just visual for where you're holding your assets. So it's a great way to, maybe do an allocation of where your money is today, right? So we call this the pyramid of risk. So a lot of clients keep most of their funds in that top area of the pyramid, which is your 401k, your IRAs, stocks, bonds, mutual funds, and variable annuities. So again, we're going to talk about that and compare that to how the fixed index annuities perform. The next section is your guaranteed money, right? Which is your money sitting in your money market, checking, savings, CDs. We always encourage our clients to have about 6 months reserved in that area. And then the third area is your guaranteed money, right? That's designed for growth and income as well as security, right? So that's where fixed index annuities shine. We also do index universal life policies, which I have another video that goes in depth about that, government bonds. So the goal is, as we're approaching retirement, right? Maybe in your late 40s into your 50s, something like that, we want to start talking about transitioning your funds from the top of that pyramid to the bottom of that pyramid. So fixed index annuities. So we're going to talk about that. So first of all, just the news on it. So it's very easy just to, if you just Google fixed index annuities, and that's what I did. And this is one of the first articles that pulled up from US News. But, obviously fixed index annuities, why are they gaining such popularity right now? And the call out there in the bottom right is the investment goal of baby boomers has shifted from desire for growth to need for retirement protection. Okay, we're going to talk how a fixed index annuity does that. So this is another part of that article if you keep reading, but every day, 12,000 baby boomers in the United States reach the age of 65, according to the Census Bureau. By 2030, all baby boomers will be 65 or older. One consequence of this demographic trend is that the investment objective of baby boomers has shifted from a desire for growth to a need for protection. It's not surprising then that annuities that offer downside protection and guaranteed returns have become more popular than those offering high growth potential. Okay, if you keep reading in that article, it also talks here about LIMRA. It says, we can see that this annuity sales data through LIMRA, which is a trade association for the financial services industry, right? In 2023, the U.S. annuity market had recorded a sales of $385 billion. So that's just in 1 year. I know our team collectively does about $1 billion a month in annuities, and that's moving money from different areas into an annuity. This is driven by interest rate hikes and the popularity of fixed index annuity products and downside protection. The second factor is proven by the fact that fixed annuities and fixed index annuities made up 67% of the sales last year, while variable annuities were only 15%. Okay, this is a dramatic change from 2013. So there's been a huge shift in the last decade from variable annuities to fixed indexed annuities. As you can see here, that in 2013, when fixed annuities and fixed index annuities were only 30% of the sales, and variable annuities were 62%. Again, a major shift from 62 down to 15%. The following will consider that fixed index annuities are, while they align with baby boomers' desire for downside protection, and whether you should include them in your retirement income plan, which we're going to talk about as I explain how these financial vehicles work. All right, so what is an annuity, right? So if you've never really looked into annuities, my job here is really just educate you as much as possible on the different options that you do have and what they're for. So an annuity is a legal contract between you and an insurance company. Okay, so who are the ideal for? Well, first of all, people with old 401ks. So I work with a lot of clients that are, still in their building phase, maybe in their 30s and 40s, but they had a previous career that they were at for 5 or 10 years, and they have some $100,000 sitting in a 401k from a previous company that's just sitting out there that's, still getting fees. There's lots of fees in the 401ks and other retirement accounts. Plus it has the downside downturns, right? So the up and down of the stock market. So we move over those to fixed index annuities for two main reasons. One is no more fees. Why pay fees if you don't have to? And number two is, again, for that downside protection. So that's one category of clients that we work with. Second thing is for clients to have funds getting little to no returns. That would maybe be sitting in your savings account, right? Just getting minimal returns. People that are 10 to 15 years away from retirement. So I'm going to show an example at the end of this video, two different of our most popular annuities for someone that's 50 years old, looking to retire around 65, and how those will perform for him. And then people that are already retired. So we work with clients that are already maybe in their 60s, 70s, and upwards, even into their 80s, that have a nest egg that, again, is not protected from downside risk, that still has fees, that we want to protect that and get ready to pass on to maybe the next generation if that's their goal. And it's really for people that prefer guarantees over risk. So that's a snapshot of what annuities are. So, some annuities have a bad rap thanks to variable annuities, right? So people like Dave Ramsey and Susie Orman, they kind of bag on, annuities, and that's where the variable annuities category comes in, right? So unfortunately, most financial advisors, they mainly deal in variable annuities, and that's where they get that bad rap. Why? Because they still have fees. They have high risk because it's still in the market. Okay, so those two main reasons is why fixed index annuities have become so much more popular in the last decade. So we've got the three different types of annuities. As I mentioned in the beginning, we're going to kind of compare the three options here, right? So first of all, you got fixed, right? This pays a fixed rate of return, say 5% guaranteed, right? So that's one option for very, very conservative clients that just want, hey, I just want that guarantee, and not looking for huge upside potential, but still a good return, right? Indexed annuities pays based on the value of the external index, okay? So we'll talk about that. And then variable annuities, you own investments inside the account, typically mutual funds. So very similar to, having your money, obviously in an IRA or 401k, your money is usually invested, say, in different funds and stocks and so on and so forth. So the next slide here, we're going to play a little game of tic-tac-toe. This is a really good visual to really get your head wrapped around why, the FIA, which basically is the fixed index annuity, is such a great route for most people. Well, first of all, you've got CDs. So a lot of people, again, if they have their money in their savings account, it's only getting maybe, 0.5% or 1%, not even keeping up with inflation. So that's like the worst place to keep your money. Well, maybe they'll decide to, put that money in a CD. So it's locked up for maybe 6, 12, or 18 months with a bank. And they might get, a little bit higher returns, maybe 4 or 5%, but they have that, that security of that money, right? And then you got the other side of the spectrum, which is mutual funds. People put their money in the market for that potential, 7, 8, 9% gain, right? So what's great about, the fixed index annuity, right? So you got CDs, typically maybe 3, 4, 5%. We're in a high interest rate environment right now when this is being recorded in 2024. And, so you might be able to get 4 or 5%, but, safety is there. So that's a key thing. But in the mutual funds, that 7% plus, the S&P average is about 7.8% historically. So you're getting, higher, better returns than a CD, but you have market risk, right? So it's going down. You could lose 20% tomorrow, unfortunately, right? So that's where the fixed index annuity comes in, and such a key product here is because you kind of get the best of both worlds. You get the safety of a CD, but you also get the high potential returns like mutual funds. Okay, so how to fund an annuity? Well, there's obviously we got qualified money, which is money from a tax-deferred account, right? So you like your IRA, 401k, 403b. If it is coming from a 401k, it needs to be from a previous employer 401k. Or if you're retired, then it's obviously a previous employer as well. So if it's your current employer, they do not allow a transfer to an annuity while you're still employed by that company. But according to a lot of the studies, the average person has 2 401ks from previous employers kind of lingering out there, and again, getting eaten away by fees and have that downside risk. So that's a great place to start for a lot of people. Again, a lot of my clients in their 30s and 40s are transferring money to a FIA because of that. Then we've got your non-qualified money, as I mentioned, money you've already paid taxes on, maybe in a Roth IRA, savings account. A lot of clients that are in real estate, they sell a property and they've got a big chunk of money. We put that into an FIA. So that's usually how we fund the fixed index annuities. So a lot of people ask, well, how can you move your money from an IRA or 401k to an FIA? Well, we can do what's called a 1035 rollover. So basically it keeps the same tax status. So if it's an IRA, it's tax deferred, or if it's a Roth IRA, if you've already paid taxes on it, well, either way, it keeps that same tax status, right? So basically we can just roll it over. And why do we do that? Well, why pay 1, 2, 3, 4% in fees? And why have market risk if you don't need to, right? So the great thing is most of our fixed index annuities have no fees. Some have a small fee if you choose to, but you get some key benefits if you decide to go that route. The ones I'm going to show you have no fees and no risk because they have downside protection. Also, some of our fixed index annuities have some bonuses to the premium. So for instance, if you move over $100,000, the insurance company has a bonus on the premium, say 10% or sometimes 15%. So they're going to give you $10,000 or $15,000 inside that annuity. What's great about that is sometimes we can use those funds to actually convert. If it's an IRA or 401k, we can do what's called a Roth conversion. We can do that at a pretty fast pace within 5 or 6 years and convert all that money to tax-free and use some of that bonus money to cover those taxes. So you can check that out in some of my other training videos specifically about Roth conversions. So let's talk about another key benefit. So what a lot of people don't understand really how indexing works. What's the strategy behind it? Why is it a safer and more predictable route? Well, first of all, let's talk about average versus actual returns. So I feel, I know a lot of people don't really see exactly the whole picture, right? So most statements from your IRAs or 401ks or investment accounts, it's going to show average returns, not actual returns. So this is a huge reason why the FIA can really give you more benefits long term and more consistency as far as the growth. So look at this example here. So we've got $100,000. and say you're getting a 7% return every year, right? Very conservative, 7% every single year. There's no major ups and downs like on a roller coaster like you get in the stock market, right? So, 7% is one. So now you're up to 107. Year 2, you're up to 114. Year 3, 122, so on and so forth. So your total at the end of year 5 is $140,000. So that average return is 7%, and the actual return, meaning your money actually returned 7% year after year over the 5 years. Okay. So now let's look at another example from, say, having your money in the market, right? So keeping your money in the market. So, and this doesn't take into account fees at all. This is just returns. So out of the 5 years here, every single year has higher returns than 7%, but it only has one down year. Well, as we know, every couple years, there's going to be downsides in the market, right? So on average, every decade, there's usually 3, downturns in the market, right? So if you use this as an example, year 1, 20%, great returns. Year 3, 9%, again, better than 7, right? So you're up to 130,000. But year 3, we have a down year, right? So it drops 18%. So not even a drop, not a 38% drop or something like 2008, which could take 10 years to make up the difference, right? And then year 4, again, nice strong growth, 9%, and year 5, 15%. Well, if you take these numbers, the average is 7%. And that's what a lot of people will show you, like, oh, we get this average return, right? So, but the actual return, meaning the actual money, how much is it worth, is only a 6.1% return. And that's only with one down year and some pretty strong years in between, right? So imagine having 2 down years, right? So it'd even be a much drastic difference than that. So this is a really good example of why a lot of our clients decide to shift their money to using this strategy of indexing, and that's what an FIA provides. Also, this is another great snapshot. So in this demonstration here, this is a 20-year chunk of time, showing the difference between indexing and having your money in the market. Okay, so if you started off in the year 2000, you had $100,000. The blue line is going to represent indexing. So for instance, you put your money in an FIA, fixed index annuity, and this annuity is attached to the S&P. To make sure we're comparing apples to apples, this is showing the S&P index compared to having the money in the market, the S&P. So, and again, we use a lot of different index strategies and with every different insurance carrier, and some of them have much higher caps and floors as well. So basically, this is showing an extremely conservative index, right? So S&P, which most people know, and this has a 0 floor, which some of ours have a 1 or 2% floor, and a 12% cap, okay? Which again, some of ours have a much higher cap than that, and I'll show you that here in the illustration ahead. So you start off the first year. Well, the first 3 years, the market, really went down 10%, 13%, 23%. 2000 and 2002, we had, 3 down years in a row. So if your money's in the market, you're now down 3 years in a row. But the great thing is right here, we call it 0's your hero. I'd rather lose 0 than lose 10% 1 year, 13%, 23%. And unfortunately, a lot of people, because of emotions, will take money out of their retirement accounts or whatever it may be when they're going down consistently, right? So that's why that really drastically affects your returns. But just say the person just left it there and didn't touch it, right? So now we start working our way back up. Okay, we work our way back up. 2007, we're finally back to $100,000. We're over here, we're at about $150,000 just using the strategy of indexing. So again, a more conservative, safer approach to holding your funds, right? Well, again, we had the mortgage crisis, 38% drop in 1 year, right? So think about that. What if that was the year you were planning on retiring? And we had lots of clients back then that were planning on retiring at that time. They had to work an extra 5, 6, 7 years to make up for that difference. Okay. So imagine you get to 65, you're excited, you got the party plan, you're ready to enjoy your golden years in retirement and do that. And then all of a sudden the market loses 38% and you're, lost 38% of your nest egg, right? So that's devastating, right? So it works its way back up. Okay. So working its way back up, fast forward now to, 2020. So 20 years in the market, right? So you're at, again, ups and downs. The actual return, again, I'm talking about actual, not averages, okay, which is not a realistic number when you have any downside risk. So it's 4.02% return in the S&P 500, okay? So you end up with $219,000. Well, if you use the strategy of indexing, again, with just a 12% cap, which again is a little bit on the low side compared to some of them we have, you still end up with $351,000 in actual 6.48% return. That's $131,000 more money, well over 50% more money, right? So by using this strategy, and you don't have the stress that goes along with it. You know, the emotional stress of checking your account, daily, monthly, weekly, however you do it, and seeing these ups and downs. You just don't have to worry about that, which actually takes a toll on us as well. So this is a really good example of how indexing works, and also actual versus average returns. All right, so additional benefits. So some of these fixed index annuities provide additional benefits that are important to people. One thing is a guaranteed income rider, which means that if you decide to activate that at any time, the insurance company guarantees they're going to pay you that dollar amount for the rest of your life, even if the account goes to zero. Which again, a 401k and IRA will not do that. If you start taking money from it, you have to be very strategic with the ups and downs of the market and not to take out too much so it doesn't run out of money. That's a huge concern for many people. The second thing is death benefit rider. So some of them, and one of the examples we have here, has an enhanced death benefit. So your family actually gets more money than the account value, right? Which again, IRA, 401ks, or any other type of retirement accounts don't offer that. That's a great way to pass on wealth to our family. And then the third thing here is a long-term care rider, right? So we call it ADL benefits, which I'll talk about. So this provides some additional income if you have the income rider activated to cover home health care and nursing home care, hospice care, any of those type of cares that you may need during those years. And I'll show you exactly how that works. So those are some major concerns that people have, that they don't get those benefits with other products. So, so our team here, we have thousands of agents around the country. Again, we work with over 80 of the top insurance companies in the country, and we pick the cream of the crop. So in the annuity side of things in our business, we have about 37 different annuity products. As the number one annuity producer in the world collectively, our team, we really pick and choose the best of the best, right? So we use top rated insurance carriers. We do over $1 billion every single month in fixed index annuities. Okay. And I'm sure you've seen some of these logos before because, most of them have been around for well over 100 years. Both products that I'm going to show you examples of, companies have been in business for over 130 years. So very safe to put your money with these companies. So let's go over an example. And every time we run an illustration is just an example of, okay, what does this annuity going to produce based on historical numbers? That doesn't mean it's guaranteed, right? We do have guaranteed options, and some of them will show maybe a 5% guarantee, and you can choose to take that option. You say, hey, 5% is good enough for me, and I want that. But honestly, I would say 90+% of our clients choose to go with the index option because you have that higher potential gain, right? So, and the good thing is they show historical numbers. They show the worst that's ever done in 20 or 30 years. They show the highest it's done in 20 or 30 years. Okay, so when we show projections, I like looking at the worst case scenario. Like, okay, this is the worst that this is performed using this particular company, using this index strategy. Okay, so this particular annuity has lifetime income and enhanced death benefit. So I'm going to go through each of the benefits of this. This is kind of we call it the Swiss Army knife of annuities. It has a lot of great benefits. So the first thing is the lifetime income benefit. So it does have the option to turn on the income rider, and you'll have money for the rest of your life, even if the account goes to zero. The second rider that this includes is an enhanced death benefit option that pays the benefit base over 5 years. So what that means is it up to doubles your death benefit if you pass away, and it pays out that money in a 5-year period. I'll explain that when I show the slide here. But basically, it gives your family more money. So if your account was worth $1 million, they're going to give your family $2 million. So again, no other type of account's going to do that besides an insurance product like this. So that benefit base roll-up equals 200% of the average credited percentage over the first 15 years. Okay, so I'll show you how that works, but basically they're going to double the account value if the money is taken out one of two ways. If you take the money as a lifetime income rider or a death benefit. Okay, so that's how that works. Lifetime payment amount, so guaranteed income, even if the account value goes to zero. I already talked about that. And then the ADL benefits. Okay, so what that is they'll actually double your lifetime income for up to 5 years to help cover those costs. Like my father, at 55, he got a brain tumor. Unfortunately, he didn't have a product like this. He had no insurance. So he ended up using his nest egg, which was his 401k and IRA, to live off of for 3-4 years while he was going through that and battling and paying for hospital bills and in-home care, hospice care, and all that, and wiped out his entire life savings, which was supposed to, basically help pay for his and my stepmother's retirement, which he ended up paying, using every single penny of that and passing away at the age of 58, right? So he actually left my stepmom with nothing at the age of 60, and she had to go back to work, right? So that's what, in our planning, we try to prevent scenarios like that from happening. All right, so let's take a look at this. And again, this is an illustration. This is one page of the illustration. So when we work with you, we're going to show you an entire illustration, but I wanted to show you what this basically looks like on paper in real numbers, okay? So, and again, this is historical. This is not guarantees as it says, but again, they have to go back at, either 10 years or whatever out of usually a 20 or 30 year period and show you, okay, this is what, the averages have been. So obviously the future, could be similar to this, right? But maybe not exact, right? So let me clarify that, right? So first of all, we got a 50-year-old, and the amount of money we moved over to an FIA is $250,000. Again, whether that was coming out of their savings account or moved over from a retirement account, right? Okay, so this actually averaged over the last 10 years, okay, 8.72%. So really strong. Again, very market-like returns, like what I talked about, right? So we're going to fast forward now, and we're going to look at what does this look like in 15 years when this person would like to retire. Okay, so they move the money over. They don't have to worry about the stress of the market going up and down, those down years, getting actual returns instead of average returns, right? Which we talked about too, which is a big deal. This is actual returns, not averages, right? So we're going to fast forward to age 65. Well, the value of the annuity now is $955,000. So great return, right, at 8%. So doubled and then doubled again, which is really strong, right? So almost $1 million. But this is the key benefit of this one. This is why this is one of our top annuities for our clients, is on the benefit base. Like, as I mentioned, they have a 200% multiplier. So what really the benefit base is 2.4 million. So the account value is 955. So if the person's like, I just want to pull my money out, they can pull out, close the policy, and they get $955,000, right? So, well, if it's an IRA or 401k, they have to pay taxes on it. If it's a Roth or if we converted it, they don't have to pay taxes on it. So that's a whole other conversation. But right here is the benefit base. So what they say is, if you take the money as a lifetime income rider, we're going to use this value to determine what your lifetime income is, right? So what is that? So right here, this column represents the lifetime income rider. So this person would get $123,000 using this illustration as an example for the rest of their life. Every single year, doesn't matter if they live to 110 years old and the account went to zero, right? So, they pay them out consistently every year, okay? The second thing is the multiplier. So this right here. So at any time in their life, which is going to happen to most people, is they're going to probably get sick, right? They're probably going to need in-home health care or, hospice care or something. So if they can't perform 2 out of the 6 activities of daily living, well, you can activate the multiplier and they will double your income to $247,000 for up to 5 years. Okay, so that to me, that's well over $100,000 more for 5 years. So that has a value of about $500,000 to cover those expenses when that does happen. Okay, and the great thing about this one is you can turn it on and off as needed, which is nice. Okay, that helps take care of that healthcare need. And then the third thing is if the person dies. So fast forward to 65, unfortunately, the person passes away. Well, the family in any other type of retirement account, they just get the value of the account, less taxes, right? Here, they're going to get $2.4 million to pass on to their family. The only thing is they're going to pay it out over a 5-year period, which is actually good for the beneficiary because it's better on taxes, right? Instead of getting a lump sum of $2.4 million, they're going to pay them $238,000 for 5 years. Okay, so to pay out that lifetime income. So that is an example of how that works. So that is one of our key annuities here for, like I said, a lot of different benefits, lifetime income riders and enhanced death benefits. So the next example here, this is the second, I would say, most popular annuity that we work with. This is strictly a growth annuity. Okay, so a growth annuity is basically designed exactly the name. There is no buttons and whistles. There is no lifetime income riders. There is no enhanced death benefits. This is strictly for like, hey, what's the best return I can get? And what this company does is they show 4 different scenarios. They show the previous 10 years. They show the least 10-year period over, like I said, a 20 to 30-year period. What's the worst 10-year chunk of time that this has produced using this index strategy with this product, the medium return and the high return. Again, we try to be as conservative as possible. We're going to look at the least return that this has shown. Okay, and again, this has no fees and downside risk. So it shows about 13%, so really strong. Okay, the other ones are net 8%. So a lot of people ask, like, why is one company offering, getting that 13%? Why is it getting 8%? Where's the other 5%? Well, the insurance company needs to make money, and they need to make up for those riders, right? So that's why the difference in these two products is that few, 4 or 5% difference. And again, this is not guaranteed. This is averages using the index strategy that our team looks at, and this is what it looks like long term. So in this case, you're 50 years old again, same $250,000 as a starting point. We fast forward 15 years. Okay, 15 years, pretty simple. It's just math, right? If it gets an actual return of around 13%, you're looking at 1.5 million, right? So, which is great. But say it got 10%, still really strong. Maybe it gets 15%. It's not guaranteed, but again, this is historical data based on the numbers that they have seen. So, and then as far as death benefit, there is a little bit of enhanced death benefit, as you can see right here. The death benefit's a little bit higher, but typically it's pretty much about the same. There is no income riders or anything like that. So this product is great for people who are like, hey, I just want the highest returns. I don't really care about those other benefits, or it's for our clients to choose both. So if someone came to me with $500,000 or $1 million or whatever it may be, we might say, hey, let's put half of it in one and half in the other, to get both benefits from both of these great products. Okay. And then what happens at this point in time, you can say, hey, if this is actually averaging, say, 13%, well, you can pull out pretty conservatively, 7-8% every year. And if it's going up 13%, well, that's your retirement income, right? So do the math on 1.5 million, 7%. You pull that out every single year conservatively, and the account value is still growing. So you're not depleting the total amount over time as you're taking your income. So this is a snapshot of fixed index annuities. Hopefully you gathered some knowledge here. And is this a good product for you? Should schedule an appointment with us? We can talk about that. We can look at your scenario. Where are your funds? What are your concerns, and what are your goals? Because that's what it's all based off of. And we can direct you to the right product. That's just 2 of our many, many different products that we use in the fixed index annuity space. So I appreciate your time. Get back to the person that sent you this video, or if it was myself, get back to me. We'll schedule a quick Zoom call so we can go over some options and look at what's going to be the best fit for you. Thank you for your time.